Welcome back to The Deep Dive, where we take a stack of sources, charts, articles, all of it, and really boil it down to what you need to know. Today, we are tackling a really specific and, well, volatile corner of the market. We're looking at the Fidelity Select Energy portfolio. The ticker is FSNX.
That's the one.
So our mission is pretty straightforward. We want to get in there and quickly but thoroughly understand how this fund works. What's its strategy for navigating these huge energy cycles, and what does the data actually tell us about the risks and, of course, the rewards.
And that specialization is really the whole story here. FSENX is what we call an equity energy fund. So basically what that means is it's investing in, well, in the whole energy ecosystem, exploration, services, pipelines, you name it. But the key thing for you to remember is this isn't some new trendy thing. It's been around for a long, long time. Inception date was way back in July of 1981.
Okay, so let's jump right in with the most eye-opening comparison, because this is the chart that just makes you stop and ask why. We're looking at the hypothetical growth of a $10,000 investment ending November 30th, 2025. And the disparity is just, it's massive. If you had just parked that $10,000 in the S&P 500, the broad market, it would have grown to $39,175.
An incredible return.
Right. That's your benchmark. Now look at this fund, FSENX. That same $10,000 grew to $19,102. And the average fund in its own category, equity energy, only got to about almost $15,000.
And that gap, I mean, that nearly $20,000 difference over that time frame, that is the perfect illustration of the kind of risk you're taking on when you decide to bet on a single, really cyclical sector instead of diversifying.
Exactly. So given that huge opportunity cost against the S&P, what's the actual argument for even looking at a fund like this? What is it even trying to do?
It goes right back to the fund's main objective, which is just one thing: capital appreciation. It is not trying to match the market. It's trying to aggressively capitalize on the upswings, the booms in the energy cycle. And the fund's own documents are very clear about this. They say it's a non-diversified fund. That term, that's so crucial for you to understand.
Let's pause on that. Non-diversified. That sounds like a technical way of saying extra risky. But what does it actually mean for how the fund is built?
It means they are allowed to, and they absolutely choose to, hold huge aggressive positions in just a handful of companies. They're doubling down. High conviction, which, gives them the potential for these explosive returns if they're right.
But it also means they're doubling down on the risk.
Exactly. If one or two of those big bets go sideways, it's a problem.
Okay, before we get into that strategy, let's just quickly cover the practical stuff. What does it cost to own something like this? The expense ratio is 0.65%.
Yeah, both gross and net, which for an actively managed fund is, pretty competitive. And look at the turnover rate. It's low, only 12%.
Right.
That's a really big clue. It tells you they aren't just day trading oil prices. They are taking these long-term, high-conviction positions in companies they believe in.
That is an interesting point, though, about the low turnover. Because the current manager, Kristen Doherty, she's only been on board since November of 2024.
Very new, yeah.
So if she's new, but the turnover is low, is she just sticking with the old playbook? Or is she showing, immediate confidence in what's already there?
I think it's probably a bit of both, but mostly the latter. Look, a low turnover rate in a sector this volatile tells you the management team, new or old, thinks the current holdings are undervalued. She's basically saying the thesis is still sound. Which I think brings us right to the core philosophy. What is that thesis built on?
Yes, let's get into that. The core investment strategy, it's very clearly active management. They're trying to find value where others don't see it.
Exactly. The whole strategy is built on this belief that energy stocks get mispriced all the time. And it makes sense, right? It's a super cyclical industry. So when commodity prices crash, earnings can look terrible, and the market just gets overly pessimistic, even on really solid companies. Here's the key takeaway. It's how they identify that real, lasting value. Their entire process is built on the idea that the ability to generate free cash flow over time, that is the best barometer of value.
Okay, that's a critical distinction. For anyone listening, why is free cash flow FCF so much more important here than, say, just looking at net income, especially in energy?
Because the energy sector is just.
Yeah.
It's incredibly capital intensive, and it carries a ton of debt. Net income can be, it can be played with through accounting choices. It doesn't really show you the actual cash you need just to stay in business. Free cash flow is what's left over after you pay all your operating expenses, and this is the crucial part after you pay for the capital expenditures.
So drilling new wells, maintaining the pipelines, all that stuff.
All that essential, expensive stuff. So it's the truest measure of a company's financial health in this industry. It shows if they can actually survive a downturn, pay down debt.
And eventually return money to shareholders.
Precisely. Without strong SCF, a company in this space is just treading water. So they're using that as their long-term map and trying to ignore the short-term noise.
So as an investor, if you're buying this fund, you are making a very specific calculated bet. You're betting on the energy sector itself, and you're hoping the manager's skill in finding these FCF machines will just amplify your returns when that cycle finally turns up.
Right, and the sources are clear. This is for tactical or strategic purposes. This is not a replacement for your core retirement account.
Okay, so let's get to the numbers, because this really shows the high-stakes drama that comes with a bet like this. I mean, the volatility in the year-by-year returns is just wild. The long-term 10-year return is 6.69%.
Yeah.
Which, looks pretty weak next to the S&P 500's 14.5%.
Yeah, not very exciting on the surface.
But the short-term spikes are just stunning. I mean, look at 2021. The fund returned 55.35%. And then the very next year, 2022, it did it again. An extraordinary 63.03%.
And that 2022 number, that is so important for understanding this fund, because that was a year the S&P 500 got crushed. It was down over 18%.
Right.
And here comes FSENX providing this almost perfect counterbalance. It was just marching to a completely different beat than the rest of the market.
But then the pendulum just swings right back. After those two massive years, performance just fell off a cliff. 2023 was barely positive, 0.93%, and then a modest 4.26% in 2024. What happened? Why the sudden slowdown?
It's a direct reflection of the commodity cycle. Those huge spikes in 21 and 22 were driven by a massive, sudden run-up in oil and gas prices. You had post-pandemic demand roaring back. You had geopolitical conflict. Once those prices just stabilized or even pulled back a little, that hypergrowth was gone instantly. The fund still made a little money, which shows the underlying companies were solid, but those index-crushing returns vanished.
Which makes the technical risk numbers so fascinating, because they just confirm this fund is playing a different game. Let's look at volatility. Standard deviation is 17.56. That's high, confirms the wild swings.
And then you get to beta. It's 0.54. Now, beta measures how sensitive a fund is to its benchmark, the S&P 500. A number under 1 should mean it's less volatile than the market.
Which feels completely wrong for this fund.
It does, until you look at the next number. The R-squared is extremely low. It's just 0.15.
And a low R-squared, anything under 0.5, tells you that the fund's movements have almost no statistical connection to the S&P 500.
To put that in simpler terms for you, if the stock market goes up 100 points tomorrow, you have basically no statistical way of knowing what FSENX is going to do. Its performance is almost entirely driven by things other than the general market. Think OPEC meetings, tanker capacity, new regulations. It's a totally different beast.
Yeah.
And that low correlation is exactly why it was such an amazing hedge in 2022.
It's volatile, yes, but the source of the volatility is completely different.
Exactly. And that brings us to the Sharpe ratio, which is negative 0.06.
Oof. So the Sharpe ratio measures risk-adjusted return. If it's negative, does that just mean that historically you took on all this risk for nothing, not even enough to beat a T-bill?
That is precisely what it means. A negative value tells you that over the period they measured, the returns didn't even beat the risk-free rate, given the huge amount of volatility you had to endure. It really hammers home that initial comparison. The 19,000 versus the 39,000, the spikes are thrilling, but the long-term path has been a really demanding one.
So now that we see that wild performance, let's look under the hood of the portfolio, because that's where you see exactly where all this risk is coming from. First, the style map. It confirms exactly what you said. It's overwhelmingly large value, almost 100%.
Yep. Big established players they think are on sale.
Then geographically, it's super focused. Almost 90% in the U.S. and the other 10% basically in Canada. So it's a huge bet on North American energy.
A very concentrated bet.
And that concentration is really the main story, isn't it? The fund only holds 35 positions in total from 33 different companies.
It's incredibly high conviction.
Right.
Which leads to this extreme concentration in the top holdings.
I mean, look at this. ExxonMobil Corp makes up a shocking 24.51% of the entire portfolio.
One company, a quarter of the fund.
And then Chevron is number 2 at 8.83%. So those two, just two companies. are more than a third of the entire fund.
It's a massive position. And look, if Exxon hits a gusher or has an amazing quarter, the fund flies.
But if Exxon has a major oil spill or gets hit with some huge new regulation,
25% of your investment is hit instantly. And that is why the fund's own documents specifically call out that narrow concentration as a major source of volatility.
so beyond just the risk of owning two companies, what are the broader industry risks they cite?
Well, the energy industry is just fundamentally unstable. It's at the mercy of huge global forces. You have wild swings in prices, the delicate balance of supply and demand, the success or failure of these multi-billion-dollar exploration projects.
Not to mention conservation efforts or big government policy changes.
All of it. Any of those things can change on a dime, and they directly impact the ability of those giants like Exxon and Chevron to generate that stable free cash flow the manager's looking for.
Okay, so let's bring this all together. What's the big takeaway from this deep dive into FSENX for you, the listener? It's a high-conviction, actively managed, large value sector fund. The whole strategy is focused on finding mispriced companies based on their ability to generate free cash flow. Its history shows these incredible short-term rewards, those 50–60% years, but also significant volatility. And it does it all with almost no correlation to the broader stock market.
And we just have to circle back to that first comparison. The difference between the $19,000 growth for FSENX and the nearly $40,000 for the S&P 500. That just perfectly shows the unique risk and reward you get with these sector-specific bets. They can be powerful tools, but they are absolutely designed for tactical use when you have a strong belief that the cycle is turning in your favor. And they come with a huge opportunity cost if you're wrong.
Which brings us to our final thought for you to think about. The fund's whole stated strategy is about outperforming through deep analysis, picking superior businesses based on free cash flow. The idea is that quality wins out. But it really makes you wonder, doesn't it, how much of the manager's success actually comes from that fundamental stock-picking skill, and how much of it just relies on the massive, unpredictable upward tide of the entire energy market to get those huge spikes we saw in 2021 and 2022. It's a really compelling question. Is long-term value investing in a cyclical sector ultimately just a more sophisticated way of betting on the cycle itself?
Something to chew on, for sure.
As always, thank you for diving deep with us. We'll see you next time.